quite often, right at the worst point in time in the market, that's when all the good news comes out, the euphoric kind of news comes out. And right at the best time to get in the market, that's when the horrible news comes out. So if you're basing your decisions on news, that may be really counter to what you should be doing.
Welcome back to Investing with Confidence. My name is Joshua David, and we're having a good time talking about the financial markets, but most importantly, exposing what's really happening in these financial markets, hopefully so you as the average investor can make better investing decisions. Don't forget to subscribe to the podcast if you happen to miss part of the show, wherever you listen to podcasts, but also check it out on YouTube. So Al, as I mentioned in the last segment, how the average investor is being conditioned by certain outlets, whether it's TV or internet or whatever that may be. If you really dive into the weeds with some of this stuff, think about CNBC. That's where a lot of people they have it on all the time. They're checking what's going on in CNBC, CNBC, and they're talking about what's happening in the markets. But they're sometimes giving advice on CNBC or making it look like they're giving advice. But if you think about this, who owns CNBC? And Comcast is the largest owner of CNBC. Comcast is owned by Vanguard. Vanguard is owned by BlackRock. Now think about that. A lot of people have these different companies or financial firms managing their money and investing in them. What are some of the things that they might be able to do or tell people to do or say on CNBC to condition the public to do what they need them to do?
Right. Well, you have to understand that those companies are in business to make money. It's their bottom line that they're looking at. If they need somebody to be on the opposite side of what they're doing, they have to maybe do something that is manipulative or in some way conditions people to think that they're acting in their best interest. And it may be just the opposite. You can listen to these shows, and what you're going to find is that quite often, right at the worst point in time in the market, that's when all the good news comes out, the euphoric kind of news comes out. And right at the best time to get in the market, that's when the horrible news comes out. So if you're basing your decisions on news, that may be really counter to what you should be doing. You can also listen to these shows, and there could be a panel of 10 different so-called professionals on there. They very seldom, if ever, will all agree on the same thing. But here's
Creates
the important
emotions.
Well, that's where it really. I mean, Jesse Livermore, probably one of the more famous traders of all time. He lived back in the 20s and 30s. In 1929, when the market crashed big time before the Depression, he made $100 million shorting the market. But what he has said is that he makes his living off the emotions of the average trader. That's us. We're the average trader. We're the public. And oftentimes we're conditioned to do things that may be counter to what is in our best interest. Think about this. Since the year 2009, right at the bottom of the market in March of 2009, when it turned around to where it is now, the S&P 500 is up about 500%. The NASDAQ is up about 1,300%. How many of you listening are up that much in your portfolios? The truth is that the public, the novice traders in their investing and trading, get a fraction of the upside, but they get the full impact of the corrections and the down markets, the bear markets. So how do you not do that? How do you not let that happen? Well, it gets back to what I said before about identifying price, identifying what makes price move. It's the elephant that's leaving the big footprints in the mud. That's the institutions. And fortunately for us, we can identify that on a price chart. On a price chart, basically everything that you need to know about a company or stock is there. It tells a story. You can tell where the institutions are trading. You can also tell where the novices are trading, which is where you want to not be. There are a lot of things that can be done to participate in these markets in a way where you are really just kind of following in the footsteps, following in those mud prints by the elephants in the stock market on a price chart. Once you have identified that timing part of it, when you should get into something, when you should get out of something, Then there's a couple of other things that are very important. One is knowing how to protect what you have. Really, that is the most important thing. Don't do anything until you learn risk management strategies. That's number one. It's not how much you make that really is important in the end. It's how much you keep.
Yeah.
And that really is going to be dependent on a risk strategy. But the quality of that risk strategy is going to be based on identifying the right price. So that's really the number one thing, the key that you have to identify. All of these things should be part of a plan. The plan should include that strategy that is a timing strategy. It should include your risk management strategies, and it should include a set of rules that you follow because, as I mentioned before, the big boys out there, the smart money, will play off of our emotions if we let them. How do you control your emotions, which they're maneuvering your emotions? How do you eliminate that?
They're playing with my emotions.
They're
What's going
playing with
on?
your emotions. Don't let them do that, Josh. Have a set of rules you follow.
Exactly.
And all of us know. I mean, we know that, we understand that, and we all have strategies that have a set of rules. Every once in a while, we think maybe we're a little bit better, and we'll veer from that, and we always get slapped when that happens. So we get back to using that plan, following that set of rules kind of as a Bible that you follow.
You're right, exactly. I mean, when Elle's talking about finding the elephant in the room, which is on a price chart, that's where you do your analysis because that does not lie. I mean, TV and internet, they have opinions, and opinions don't drive the market. It's actual price. What drives price? Supply and demand, which is the big firms, the financial bank, the big banks, the JP Morgans, the Goldman Sachs, the Buffetts of the world, the big money, they move this market. So you want to understand what is the right price, not when. Time is great, but if you don't have the right price, that's where you have that. You want to have a low entry point, or I should say a low risk, high reward, high probability entry point, which is the right price. That's typically at or near a turn in price. And you have to have that plan, right? So if you don't have a plan, you're just guessing. So those rules within the plan helps you disconnect from any of those emotions as well. Now, when you have a trading and investment plan, it involves rules. And you have to have the right rules for the proper asset that you're going to trade and invest with. Now, if you think about it, stocks are at all-time highs. They're super expensive for the average investor. So sometimes it almost prices people out of the market, and that's why I believe sometimes people don't get into the markets because they don't feel they can or they don't feel they have enough money. Well, there's other assets that allow leverage. Basically, you're being more capital efficient. Talk about those leverage asset classes and maybe even times of day that investors love to trade them.
Yeah, I think it comes down to this kind of an analysis, Josh. Let's just say you're going to dig a ditch. You can either dig a ditch with a backhoe, or a shovel, right?
All right.
Okay. Both get the job done, right?
Well, it depends on what you're doing.
Yeah, but you can dig a ditch with a shovel, you can dig a ditch with a backhoe. But one tool is going to provide benefits over the other.
You need that 330 cat is what you need.
That's exactly what you need. And the same thing is true in the financial markets. Instead of, maneuvering the financial markets with a shovel, so to speak, why not use a backhoe? Why not use something that really can give you a greater, bigger bang for your buck, so to speak? And it's like having an employee with a business. If you had an employee that went over in the corner every day that he showed up and just went to sleep and slept all day long, you wouldn't get any productivity out of that person. You'd probably fire them. Look at your money the same way as an employee. Every dollar, you want to get the maximum productivity out of it. How can you do that? How can you make a dollar be worth more than a dollar? You use leverage.
Yeah. And just to go a little off topic here, I was in the industry for a long time. I actually operated backhoes all the time.
Yeah, that's
and
correct.
we were operating engineers. You know what they called, what we called the laborers that would use a shovel for digging? Dirt cultivating operating engineers.
As they should be, right? Everybody should have a title.
Yeah, exactly. But talk a little bit more about this leverage, but these times of day that people like to invest with them.
Well, the stock market's open 6.5 hours. It opens in Minneapolis. It opens at 8:30 and closes at 3 o'clock. That gives you 6.5 hours in which you can deal with things. If you are short term, or if you want to be, say, a day trader, which some people want to do. And by the way, that's not what all of our students want. You can choose the amount of time that you're doing this. You can choose whether you are trading on a very short-term basis, a little bit longer term. Maybe you only want to invest once or twice a year. Those are all things that we teach our students, regardless of what your time frame is. But it's using the right assets to give you the best bang for your dollar, the best benefit for the trades that you're going to be doing. You already have learned the timing mechanism. That's the core strategy. That's the first part of what you need to know in your plan. The second one is, what is the right asset to help you get to where you want to be? And you should look at where you want to be in 5 years or 10 years or 20 years, whatever your time frame is. You really need to identify that first before you can identify the right asset, because it may be different for one person than it is for another. Futures and Forex trade 24 hours a day, and that gives a lot of people that work during the day an opportunity to participate not only in the financial markets, but also to participate kind of in a global fashion, because when our markets close, we're not so great. Our markets aren't so great that everything else just shuts down in the world. The other markets around the world are open and functioning and maybe doing things that could impact our market, our stock market, when it opens. The futures and Forex trade round the clock, which is a great opportunity, or gives you a great opportunity to choose when you want to do this. There is another disadvantage with using stocks, Josh. You mentioned the cost. Some of these equities are trading at extremely high levels now, $2,000-$3,000 a share, $400, $500, $600 a share. And what can happen when the stock market closes? Let's just say some bad news comes out. It's a bad earnings report on a company, or the CEO is caught in a less than desirous situation. The next day, a stock can open up at a totally different price. Let's just say it closed at $300. It could open the next day at $200 or $100. That's a big gap down, and it can happen because the market is closed between 3 o'clock and 8:30 the next morning. With the futures market and the Forex market being open 24 hours, that gap really, it's almost impossible for that to happen.
Yeah, and if you think about it this way, I mean, hopefully this stays in people's minds when the risk that comes along with stocks. If you have Apple stock and they hire Justin Bieber as the CEO on a Tuesday night, what's going to happen to that stock? It's probably going to tumble. Nothing against Justin Bieber, but he may not know a lot about Apple stock or Apple company.
I think you just said something about Justin Bieber.
Hey, I got Bieber fever. I'm kind of a Bieber fan, so I'm just giving an example here, Al. But that's the great thing is when you understand that stuff, you can minimize or mitigate that risk.
Exactly.
And how you can do that is by using other assets. Understand what the futures market is, the Forex market. These markets trade in the evening, so when people work during the day, they're stuck to evening hours. And that's kind of one of the things that we're seeing a lot of people want to understand is what can I do in the evening? What can I do on my spare time to really give myself more choices? Yep. And that's what it all comes down to. And you mentioned something very, very interesting. You were talking a lot about the core strategy that Online Trading Academy has. It's a strategy that's designed to teach you to make better investing decisions. So once you understand how to make those better investing decisions, gives you more confidence going in. Say you're building a retirement, or say you're going into retirement, you want to have that confidence. Now, I want to continue talking about these other assets, but I want to talk about an asset that people like to utilize with stocks. Coming up next, we'll be right back.